Okay, let's just jump right in. I want to start with a number, and honestly, it might just shock you. It's a figure that perfectly frames why we have to talk about this right now. 1.5 trillion euros. Yeah, you heard that right. Just let that number sink in for a second. That's more than the entire economic output of Sweden. It's more than the market value of Amazon. And get this? That's how much money Italians have just sitting in their bank accounts. Money that's not working, not growing, not doing a single thing. But here's the kicker, the really crucial point. That money, it's not safe. Not at all. While it sits there, it's actually shrinking. It's losing value every single day. So in this explainer, we're going to break down exactly why this is happening and, way more importantly, what you can actually do to stop it. So to really get why that 1.5 trillion euros is just evaporating, we have to face a simple, maybe uncomfortable truth. The old rules of saving, they just don't apply anymore. The whole financial world has changed, and that means our game plan has to change with it. I have this really vivid memory of my grandmother. She had this old tin can she kept on top of a kitchen cabinet, and every month, like clockwork, she'd tuck a few banknotes inside. For her generation, that was wisdom. It was security. But today, that same exact move is pretty much the surest way to lose money. That wise old tin can, it's turned into a leaky bucket. And that leak, that hole in the bucket, it's got a name: inflation. Honestly, you should just think of it as an invisible tax. It's the most unfair tax out there because you don't see it coming out of your paycheck, but it's silently stealing your purchasing power year after year. Like, imagine you have 10 grand today. With just 3% inflation, in 10 years, that same 10 grand will only buy you what about 7,500 euros buys today. The number on your statement doesn't change, but what it's worth, poof, a big chunk of it is gone. And here's the thing. In Italy, this problem gets put on steroids. It's not just that prices are going up. The real double whammy is that our incomes just aren't keeping up. And when you see the actual data on this, it's absolutely staggering. Just look at these numbers. Over the last 30 years, 3 decades, Italy is the only country in the entire EU where real wages have actually gone down. We're talking a drop of almost 3%. Now, compare that to the average for other developed countries. They saw a 33% increase. Let that sink in. While everyone else's paycheck was growing by a third, ours was actually shrinking. So what happens when your wages are stuck in neutral and inflation is eating away at your savings? You get a massive and growing wealth gap. In Italy today, the richest 10% of families own almost 60% of everything. And the bottom half of the population, they own just over 7%. And the big secret here? It's not just about how much you earn. It's that the wealthy put their money to work. Plain and simple, they invest. Okay, so if saving clearly isn't enough, then what is the answer? Well, it all comes down to a really crucial shift in how we think about money. It's time to figure out what it really means to make your money work for you. All right, let's get crystal clear on this, because the words matter. Risparmiare, saving. That's my grandmother's tin can. It's just putting money aside. And don't get me wrong, it's essential, but it's only step one. Investire, investing. That's taking the money out of the tin can and putting it to work. It's putting it into a system designed to grow over time. We're not talking about gambling or picking the next hot stock. We're talking about owning a piece of the entire global economy's growth. Now, what's so fascinating is how most people go about this. They walk into their bank and they're sold one of these active funds. Where you pay some professional manager a high fee to supposedly pick the best stocks for you. Sounds great, right? Well, what if I told you that over a 10-year period, a whopping 98% of these expensive funds fail to even match the market average? 98%! It's absolutely true. Let's make this really concrete. Imagine 2 people, Luca and Marta. They both do the exact same thing. They invest 300 euros every month for 30 years. And let's say they both get a 7% average return before fees. So far, so identical. But here's the one tiny difference. Luca goes with that typical bank fund and pays 2% in fees. Marta, on the other hand, chooses a super low-cost passive fund, an ETF, with fees of just 0.2%. Fast forward 30 years. Luca ends up with 245,000 euros. Hey, not bad, right? But Murda, she has 340,000 euros. That's almost 100,000 euros more. Think about that. She didn't pick better stocks, she wasn't smarter, she wasn't luckier. The only reason for that massive difference is that she paid less in fees. That tiny percentage isn't just a fee, it's a huge transfer of your wealth from your pocket straight into the bank's. And hey, don't just take my word for it. Listen to the most successful investor of all time, Warren Buffett. He put it perfectly. In fact, he famously made a $1 million bet that a simple, boring, low-cost index fund would crush a hand-picked portfolio of sophisticated hedge funds over 10 years. And guess what? He won. By a landslide. It wasn't even close. So all of this leads us to the actual solution. And it's a strategy that's simple, incredibly effective, and really powerful. People sometimes call them lazy portfolios, but I think we should reframe that. Lazy isn't the right word. It's not about being uninvolved. It's about being efficient. And there are a few really simple ways to do this. The simplest, a one-fund portfolio. You just buy a single global stock ETF. Boom. You own a tiny slice of thousands of companies all over the world. Want a bit more stability? You can do a two-fund portfolio, adding some bonds in there to smooth out the ride. You can even go a step further and add things like gold. But here's the most important thing I can tell you. The best portfolio isn't the most complicated one. It's the one you can actually stick with for the long haul. Okay, so let's recap. The method is dead simple. It's proven to work. The tools to do it are cheaper and more accessible than ever before. So that leads to a really interesting question, doesn't it? If the method is so simple, what's the real problem? What's the biggest thing standing in our way? Is it some Wall Street conspiracy? Crazy complex algorithms? The government? Nope. The real problem, it's much, much closer to home. It's you, it's me, or to be more precise, it's our brains. It turns out neuroscientists have shown that the part of our brain that gets all excited about making a quick buck is the exact same part that lights up for things like addictive drugs. We are literally hardwired for the adrenaline rush of a gamble, not the boring discipline of a long-term plan. And this chart just lays out the trap perfectly. Look, if you check your portfolio just once a year, you'll probably see a loss maybe 1 year out of every 4. No big deal. But what if you check it every single day? Well, you're going to see red on your screen about 120 times a year. Now, the actual risk of your investment hasn't changed at all, but your emotional experience, seeing all that red, has gone through the roof. And that's what tempts you to panic and sell right at the bottom, the worst possible moment. All right, so before you run off and buy that global ETF, and I know you might be tempted, hang on. There's one last piece to this puzzle, and honestly, it might be the most important one of all. You see, investing, that's the roof of your financial house. It's not the foundation. Before you even think about investing for growth, you have to build this pyramid of security first. The base, the absolute foundation, is your emergency fund. That's 3 to 6 months of your living expenses sitting in cash, easy to get to. The next layer up is protection, having the right insurance to protect you from those what-if catastrophes in life. And only when that foundation is rock solid, then you can start building the peak, which is your investment portfolio. Here's a good way to think about it. Your investments, they're like the sails on a boat. They're what's going to catch the wind and move you forward. But you can't really raise the sails if the hull of your boat has a big hole in it, right? Your emergency fund and your insurance, they plug those holes. They make sure that when your car breaks down or something unexpected happens, you don't have to tear down your sails, sell your investments in a panic just to stay afloat. So let's bring this all home. The world our grandparents lived in, it's gone. Investing isn't a luxury anymore for the rich. It's a straight-up necessity for financial survival. But you know what the beautiful thing is? The spirit behind it, the core idea, is exactly the same. Your grandmother's gesture of wisdom was carefully folding a banknote and tucking it into that tin can. Your gesture, the modern version, is just setting up an automatic transfer every month into a low-cost global ETF. It's the same act of saving for the future, but the tool you have now is just infinitely more powerful.